The second you buy inventory, you're not buying product, you're buying cash flow problems. You're taking cash that could be working for you. Let's talk about something that quietly destroys more businesses than almost anything else. It's inventory. Not bad sales, not bad marketing, inventory. And I'm talking about the inventory you bought with good intentions, the inventory that was supposed to move fast, the inventory you thought you needed, and the inventory that's still sitting on the shelves like a retirement home for your cash. And the sad thing is, most business owners don't realize this. The second you buy inventory, you're not buying product, you're buying cash flow problems. You're taking cash that could be working for you, hiring employees, paying down debt, improving equipment, building a marketing budget. What you're actually doing is locking it into physical goods that might take weeks or months or even years to convert back to cash. And the ugly part is, most business owners don't know how much inventory they actually have or how fast it moves. They're guessing, they're hoping, and the hope freezes cash. So today I want to talk you through a simple way to fix your inventory problems. Even if you are a small shop, even if you're in the trades, even if you're in retail, even if you're already drowning in stacked shelves and boxes. We're going to break down 3 parts: understanding the real problem, calculating your true inventory turns, and the step it takes to free up cash fast. Let's get into it. Part 1. The real problem isn't inventory, it's timing. Inventory isn't the enemy, bad timing is. Businesses get crushed when the timing between buying inventory and collecting cash gets out of sync. I'll give you a real scenario I see constantly. A business buys $30,000 of parts and materials somewhere in January. Sales are slow in February. Customers pay late in March. Suddenly, the owner is wondering where all their cash went, even though work is all lined up. The cash didn't disappear. It's sitting in the back room staring at you. This is where most owners get blindsided. They think, we're busy, so we're fine. No, busy doesn't mean healthy. Busy with cash tied up is the fastest way to stay stressed. You can be profitable on paper and still be broke. Inventory is the perfect example. Profit means nothing until cash comes in the door. This is why understanding inventory timing is so important. The longer your inventory sits, the more cash slows down. The slower cash moves, the harder it is to pay bills, take advantage of opportunities, or even survive a rough month. So let's calculate the real inventory problem, the number that exposes everything: inventory turns, or inventory turnover. Part 2, inventory turns, the number that tells you the truth. Inventory turns answers one simple question: how many times do you sell through your inventory each year? The formula is really simple: cost of goods sold divided by average inventory. But you don't need to memorize the formulas. You just need to understand the meaning. If your turnover is 10 plus times a year, your inventory is moving pretty fast. 6 to 9 times per year, decent, but there's room for improvement. 3 to 5 times a year, cash is slowing down. And 1 to 2 times a year, you're suffocating your business. Let me give you a simple example. If you carry $50,000 worth of inventory on average and your annual cost of goods sold, specifically in material, is $250,000, then your inventory turns is 5. That means your inventory sells through about every 2.5 months. But if your inventory turn was, say, 2, that means your inventory takes half a year to move. Imagine buying inventory in January and not turning it into cash until like June. That's why businesses panic. Most business owners never run this number. They just buy inventory when they need it, guess when they think they're going to be low, and hope it all balances out. That's not a strategy, that's gambling. Once you know your turnover or inventory turns, you know whether inventory is helping you or it's choking you. And if your turnover is low, don't panic, it's fixable. There are 3 simple levers to pull: buy less, buy smarter, and move inventory faster. Part 3, how to free up cash fast now. Let's get into the actual fix. This is where cash flow improves immediately. Number 1, buy smaller quantities, but more frequently. This sounds obvious, but a lot of businesses buy in bulk because they think they're actually saving money. They're not. They're trading cash flow for a tiny discount. If you buy $20,000 of inventory and you save 5%, but it takes, let's say, 6 months to move, you're paying interest on that decision and also stressing your cash. If you buy smaller quantities every few weeks, you keep more cash in your pocket and reduce the chance of dead inventory. Slow moving inventory is a liability. Fast moving inventory is an asset. Number 2, let's get better at forecasting your demand. Most businesses don't forecast, they react. And reacting creates excess inventory because you start buying just in case. You're trying to keep ahead of it. Here's a simple forecasting method. Look at the last 90 days and ask, what sold the fastest? What sold the slowest? What did we reorder most often? And what did we reorder too early? Your purchase decisions should be based on patterns, not panic. Number 3, create a never out list. This is a huge one for the trades and service companies for sure. You don't need to stock everything. You need to stock what keeps your business moving. Your never out list should include the top 20% of the items that drive 80% of your work. Everything else can be ordered as needed. This reduces inventory volume immediately without hurting your workflow. Number 4, negotiate with your suppliers. Suppliers want volume. You want cash flow. There are many ways to meet in the middle. Consider asking for smaller minimum order quantities, better payment terms, discounts based on rolling totals, not bulk orders, faster shipping options. A lot of suppliers will work with you if you communicate clearly. You don't need to stock for 6 months worth of inventory if your supplier can get the product in just 3 days. Number 5, turn dead inventory into cash immediately. Every business has dead inventory. The stuff that sits, the stuff that you regret buying, the stuff that haunts you from your back room. There are 3 options. Let's get rid of it. Let's sell it at a discount. Bundle it with something else, or even return it if it's possible. Donate it for a tax write-off. Throw out and learn. Dead inventory is dead for a reason. Don't let it take up space and cash. Move it out and reset. Number 6, build a weekly inventory rhythm. This is the part that changes everything. Every week for 10 minutes, just look at these things. What came in, what went out, what's sitting too long, what needs to be reordered, what doesn't need to be reordered. Inventory should never be a surprise. A weekly rhythm keeps it honest. Part 4, the one trap that destroys cash flow. Here's the biggest trap: buying inventory based on revenue instead of cash. A lot of businesses say, we had a great month, let's stock up. But if the receivables haven't come in yet, then you're buying inventory with imaginary cash. This is the fast way to create cash stress. Only buy inventory with cash you actually have, not cash you expect, not cash you hope for, real cash. The 13-week cash flow system I talked about in the previous videos ties directly into inventory decisions. It tells you the real timing. It keeps you from overbuying, and it keeps your bank account from ever getting drained. Part 5, the inventory conversation that no one wants to have. Let's be honest about something. A lot of business owners buy inventory for emotional reasons. It feels good to be stocked up. It feels safe. It feels prepared. It actually feels progressive. But excess inventory is not safety. It's risk. It's trapped cash. It's trapped cash that puts you in a weaker position over the long term. The healthiest businesses in the world, they run lean. They know exactly what moves, they know exactly what doesn't, and they use systems to make sure that every dollar they spend has a job. Inventory should work for you. It should never work against you. So here's the bottom line. Inventory is not a product decision, it's a cash flow decision. And when you understand how fast inventory moves or doesn't move, you take back control of your cash. Your goal is simple: buy smarter, move faster, reduce what sits, free up cash. When you do all of this, stress goes down, cash goes up, and the business becomes lighter and healthier. Okay, that's it for this one. If you agree with the content, let me know. If you disagree, I'm open to debate. Either way, just subscribe. Until the next video, stay profitable.